War Room ICS number 20, trainee Alan Vergara, the presidential cycle and the decennial.
Hola.
Hola, Alan. Ready?
Ready, sir.
Okay, here we go. Now, one of the important things that we have to keep in mind is cycles. Seasonal trading is very important to understand how the S&P or particular companies may behave going into months of the year. For example, sometimes Thanksgiving, for example, may put some pressure on big retailers. Companies may not be receiving, if they're not well positioned into the online space, they may be facing challenge because buyers are no longer going to malls, to the traditional brick and mortar places to buy. They're buying online. So if your company, for example, is not positioned that way, you will suffer. For example, we had tremendous success with TGT because one of the biggest revenues that they're growing is their online presence by 30%. That's how they've been in business. But on the other hand, if you look at Home Depot, HD, they're not doing so well. So they're a little bit behind the game. Also, you have the case of Best Buy, where they're actually doing very well against big players like Amazon, for example. So that is giving them the opportunity to still be in the game. Now, understanding this as well will give you an idea of what we're going about to discuss. This is not forecasting, this is just the way things are, and it's based to understand before others what will happen in 2020 to 2022. I'm talking about the decennial cycle. I will send this to you for you to have it read a couple of times, and if you have any questions, you please go ahead and let me know. But the first time I heard this concept is based on Larry Williams. I started my career working for a small firm. The owners were from the Netherlands. And one thing that they did very well was to get us access back in the days from Panama to a lot of brokers in London, Man Financial, for example, that no longer exist, and others in Chicago. And one of the things we used to do, we used to trade a lot of futures contract. And I used to buy at some point $2 million worth of gold contracts for Dr. J. Alexander. Dr. J. Alexander, he was a doctor. Well, actually, he's a doctor. He's still alive. And he made initially about $8 million profit with a $2 million capital. All he did was buy gold, hold, and sell. That's it. Nothing more. Of course, $2 million worth of capital. He had an idea what he was looking to do. Take in consideration that this took place sometime between 2006 to 2008. Okay, so that was when gold went all the way. Silver was around $7, went all the way to $14, meaning it doubled. So he bought gold and silver. Gold was trading around $600, went to $1,000 at the time. Okay, so why share this information with you? It's not to impress you or to talk over past experiences. It's to share with you the background of scenarios that I've been going through in my life to come to this point, and the things I have seen others doing that kept me going, understanding that you can win the game. There's a high probability that you can win the game. And what we need to understand about this decennial cycle, for example, there's this comment about the Dow going at 40,000 by 2009. This paper was wrote by a PhD and make reference to Harry S. Dent Jr. Harry S. Dent Jr., it's a forecaster, is out there, and he's been calling, for example, he's been calling gold at $800. I can see that happening and shouldn't surprise anyone. And there are two factors to consider. Stocks, over a period of time, they make your wealth grow by 7-8%. That's the overall expectation of you investing in stocks in the long term. 7 to maybe, why not, even 8-9% per year. Okay? And there's a thing. That's why the system has been designed away in the US to structure retirement based on mutual funds investing in dividend stocks. Most of the money that these managers make come from dividends all the time. There's a little bit of growth, yes, but the big player is the dividend. That's the trick of the game. That's how the US has been built. It's not the same in Europe. The structure is different. That's why everyone wants a piece from U.S. equity indexes. Now, gold, on the other hand, yes, it's a hedge, but it's a hedge against inflation. And also there's another challenge that comes with buying gold. Buy gold, you need to storage it. You have to pay for that. And gold has one enemy that no one tends to talk on the media. Gold pays no dividend. It has zero dividend.
Yes.
And that's a challenge because you cannot really build retirement without the dividend.
Right.
Yes, you can grow, and yeah, let's say, why not? Gold goes up $250. Woo, great.
Yeah.
That's it. That's over. That's all you're going to get out of it. But with Microsoft, Walmart, and other players, you not only get the growth, but you get the 2%, the 3%, even some stocks pay 6% yield. They've been doing this for years because they're in specific industries that they are needed, and therefore they have this massive amount of cash always coming back to them. That's not the case of gold. Why I'm explaining all this? Because it's perspective. Perspective, understanding what we're doing, how you win the game. The chart that you see in front of you is an estimation of what happens on presidential election year. And it goes like this, pretty simple. This is for you to read it and understanding. There's the decade cycle, the decennial cycle, there's the 5-year cycle, and the presidential election year cycle. And also the pre-election year. Now, this year only, the S&P estimated is doing a great thing. It went up very good. Absolutely, very well. So what do we expect in 2020? I do expect still to mark the levels for an all-time high. Or I will share with you the levels and studies that I have for you to always have those in mind and practice them on a daily basis so you are aware of what may not take place. Now, the 5-year cycle. The question that this PhD poses is there any significant value in this information? Yes, it is, because it will give you an idea. For example, and I will share with you over here, where we have it. And this is also to be aware. Clearly, year 5 has outperformed, while years 8 and 9 have also been quite positive. Which year is 2019?
Which one is 2019? The year 5?
No, it's the year 9.
Oh, the year 9. Okay.
Yeah. Clearly, year 5 has outperformed. Remember, we're talking in the period. I'll have to teach you this. Okay. 2009 was the mark. So we'll talk 2010, 2020, 2019. This is the year 10-year period. This is the new decade.
Oh.
Okay. Next year is the new decade. So
okay.
What is the year 9?
Yeah.
19.
Okay.
And hold a second, please. Just hold a second. Apologies for that. I'm back. Thank you for waiting. Okay, so 2019, what this section is saying that years 8 and 9, they are positive. What happened this year? Like 3 to 4 all-time highs for the S&P 500. Because year 9 is very good. On the other hand, to pay attention, years 7 and 10 have underperformed. Very important to understand that. So what that means for us means nothing in a way, because we are prepared, because we understand price rotation, and we understand also trend Fibonacci. We also understand volume profile, and we have the leading indicators of the insiders. So we will be prepared for anything. If the S&P this year just bounce back to the levels that we know already, they will just play those levels. What it means
Question.
Yes, go ahead, please.
So year 10, it hasn't happened yet because it's not 2020.
Exactly. It's coming.
but it said it have underperformed, so it's kind of like a past tense.
Statistically speaking, year 10 is not a good year.
So so it is a prediction.
It is a prediction.
Not happened yet.
Okay. Yeah, it hasn't happened yet. It had happened already that the year 10 has not been productive. But remember, there is another scenario that is clashing with this view of the decennial cycle, and that is, I can put it, the presidential election year, and that's the challenge, and that's why it could lead to a potential change on this view of the decennial cycle, because it's clashing with the presidential year. And what happened in the presidential year? Look at the green: 14%, 17%, 14%, minus 3%, 11%, 4.2%. Look at this: 26%, minus 6%, and nothing else. Look at previous year from 1951 after World War II: 8%, 2%, minus 9%. So if I were to take just as a linear, which is not accurate, but just to give us an idea, 9 minus 9, let me just remove all, because this is important to have in mind. Since 1951, 1 second, 9%. Then sometime in...
There's a lot more positive than negative.
There you go. Yeah. Just by eye, you can see that. Okay, in the decade of 1981, we have minus 3.7%. Then the decade of 1991, we have minus 6%. And that's it. That's what we're playing. We're playing with this. Okay. Now, if I were to look at this, I can easily say minus 5%. Now, this is the worst case in a base of a range. But that doesn't mean that the S&P 500 can easily create a new all-time high and then end the year minus 5%. Look at this, okay? Yeah. So it's an understanding. So if we're trading at this moment, just for a reference, 3,220, and we get hit by a negative year based on the presidential year cycle, which is a period from 1951 to today's date, we're talking that this is about 350, let's say 160 point. That means that 2020, January 2020, as soon as the market opens, if the price of the S&P 500 is 320 and we end the year at 360, I think it's this 60, 3,060 point, we will be a year down for the presidential cycle. And this is our worst case scenario for the year ending value of the S&P 500 in 2020, 3,080. You already know what's the worst case. Maybe a little bit more, but that's it. So some range between 3,080, 9% will put us at 3,020. That's it. That's your range for year close worst case scenario based on the presidential cycle values in 2020. You know that, Alan. That's it. You already know. You can talk more than the CNBC host right now. Mathematically speaking. Okay? This is, yes, sir. This is what it is. It's nothing new is going to happen out of this range. That it can go lower. Oh, yes, it can go lower. Absolutely. It can go to, why not? There are two values to keep in mind before we jump to the charts. We have to keep in mind 9,040, 2940, and we keep in mind 2,800. Those are downside levels to keep in mind. But year end, the S&P in 2020 shouldn't close lower between 3,080 and 3,080. I will say 3,020. That's it. Bye. Let's go to the charts, okay? So we have this information. Read it over the weekend. If you have questions, just shoot the questions and we'll go. Now, time to go to the charts, and let's see a few very important aspects to keep in mind of the S&P 500. Now, I'm going to go back to three important charts on the S&P 500 that I already shared this with the War Room, and I have them since sometime June, July of 2019. Okay, what's this one? This is a completion of this. There's this potential high. This will be absolutely the peak in 2020. So here, I won't take too much time, but just to explain, one of the things that's happening in 2019 that a lot of elite weight traders and a lot of analysts got to run is understanding the secret, the hidden trend Fibonacci that no one talked in 2019. This one. This is the range that happened from the bounce from 2317 all the way to 2956. When this happened, then the S&P put a double bottom at this level, 38.2% Fibonacci, 2712. Do you see that in your screen?
Yes. Yes.
Okay. No one talked about this right here in front of us. So when this happened, everyone was like, yeah, it's going to crash. Yeah, it's going to crash. This area was the key because of this.
That's a strong support.
But no one talked, I bet you.
Yeah.
In the name of my grandmother that went to the U.S. She lived in Austin. She lived in Dallas, Texas, and put me through school. Me, my sister, my brother, because my father abandoned us in 85, 86 when my mom was pregnant from my little brother. Went to New York, never sent $1 to help us. No one in the U.S. talk about this. The hidden level that was the key to find success in the S&P 500 was this. Once the S&P plays this double bottom here, and also there is a candlestick formation that I use with an indicator that I have a MetaTrader for. As soon as this happened, all these levels had one key aspect, and I told you this before, and it's on your sessions. Once the break of the zero level happens, it's activated. And once it's activated, prices cannot close and open below 23.6% Fibonacci. And the evidence is here. Look at what this candle did here. It went down and bulls defended. Bulls defended this because technically speaking, in front of us, the Fibonacci was already activated by this candle. So in this candle, it went down, touched, and came back. It never closed. It never closed below 23.6%. And then to the moon.
That's it.
But right there in those 2 months, all the Elliott Wave traders, everyone talking about it's going to 26. I'm like, no, dummy, it's not going there, dummy.
They probably don't know the trend Fibonacci.
They know, but they just want to come with a mama jumbo. And Elliott Wave, no offense to Elliott Wave traders, because they have one thing that all traders have apparently. It's like they have multiple losses and then they find this big winner and they save the year. That's what actually Elliott Wave traders do. Multiple bad trades and then they come with this big Kajun tsunami and then they make all the money back and a little bit. So why share this with you? And please go ahead, go and look into the war room. Take your time, look into my S&P charts many months before you joined. It was there.
Yes.
I talked to Holly about this multiple times. The hidden trend Fibonacci that no one talks. And this is why a lot of people were biased. And also another thing that I have said multiple times, please look into the archives of the Telegram group. Stop with the recession story, please. Oh my God, 2019 was full of headlines recession. And the drama of the inverted yield curve. Oh, Jesus Christ, man. It was horrible. It was horrible. I was like, dude, what you guys understand that if we go into recession, even you guys that are on TV, you're going to lose your jobs.
Yeah.
So what is this drama? So the negative bias against the U.S. economy is gargantuan. It's like, please, you don't know what is a recession. You really need to go to Italy. Really need to visit Europe so you see what is a recession. So I share this with you, and now let's continue. I'm telling you, the things people talk are just hilarious. And here are the 3 charts that I want you to record on your memory. Chart number 1. See the push, all the trend. Look at the trend line, okay? It should actually, it's time for me to extend this one. Like this. Okay, I'm gonna save it, my profile. Now, again, look at the extension. We have here the hidden Fibonacci. Look at the 38.2%. I'm not gonna assume, just show real quick. Look at the levels. Now, in this version, look at what I'm doing. I'm working, which month, which time frame I'm working with?
Monthly.
Working on monthly. You want the big money. Now, based on this information, there are 2 things to consider. Number 1, I'm gonna write it down. There's still on the table about 240 points to the upside. Okay, based on this trend Fibonacci on monthly. The Fibonacci is already what? Activated.
Activated.
Number 2, what is your value to respect? 23.6% Fibonacci. So, number 2.
It's a strong support.
Yes. So, number 2, don't be surprised that you will see.
If it goes down.
If it goes down. And I guarantee you, in 2020, the S&P 500 goes at least 1 point in time, it will touch 2861. Don't be surprised. And from current levels, that will be about 140. So there's a negative opportunity for the S&P to rotate lower as low as it's 100, 220, 140, 220, 360 points to the downside. 220 from what we are right now.
Not below the 2861 level, right?
Correct. But that means that it can go there. It can come and so that will represent a rotation, bearish rotation, about 360 points to the downside. And you will be fine. You shouldn't be scared. You shouldn't be surprised. What you must be prepared is to ride this back up like a professional via call options. And those call options are going to be in the cents.
Wait for the perfect entry.
Exactly. That moment. The rotation will give you the best value for those calls. But you have to prepare. Okay? So that's very important.
Okay.
So these are very important levels. First, 1, understand that there's still on the table to the upside 240 points estimated, and this is conservative for the S&P 500. Second, that there's a potential bearish rotation that can lead, mathematically speaking, the S&P 500 all the way to the 23.6% trend Fibonacci on the monthly chart. And that is not recession. That is a pullback. That I bet you one thing, insiders will be massively buying, because I have pointed out multiple times, insiders are not going to add more cash now. We're at the highs. And number 3, and I want you to go with this thought. People don't talk about it, but professionals have pulled out of the market via mutual funds, passive ETF, roughly close to $1.9 billion. This information is real. I will send you by email where I got this information. I already knew this because I talked to Holly. There's a guy that I follow. I think he works for Bloomberg.
Yeah. What is 19 billion?
$1.9 billion flow out of stocks in 2019. Okay. So $1.9 billion cash, hardcore cash, was taken out of the market. So that means that all this money can come into the market, but it will not come in the market at the current level. It's too high. The price valuations, okay, let's say for one example, valuations can be okay, but why are you going to pay that valuation when you can get it for 20, 35% less, 10% less? So you wait. So these monies on the sidelines. Okay. Also, there's a lot of there's this drama with the impeachment of Trump or not Trump, who is going to win the election. So the big money is cautious. They're waiting. Okay.
Yeah.
So very important. These points have them.
So we're probably going to see the big money at the 23.6 level.
or before, because you cannot throw
Or
all the
before.
money on that level. You start, remember, they start structuring levels, building up the
Yeah. Okay.
positions.
Okay.
Now, second chart. This is very important to understand. Some time ago, and this also comes based on price rotation. Okay. What I will do is that I will remove this now because we already have understanding of trend Fibonacci, and I will clean my chart to conclude this only based on rotation levels. Sometime in 2016, the S&P 500 started doing something very funny. It started creating clusters of 150 points, okay? What that means is that once the S&P wants to create a new level, it does that based on 150 points. That's 3,208. I'm going to show you here. I'm going to conclude this. 8 here. So the last rotation and the chart won't allow me to lie. Look at this. Touch, break, open and close, new price range, push, touched, and project. This range here is 150 estimated, 152. Let me see. Oh no. Okay, here we go. Look at the price, what the price is doing. Okay, 148. Okay, 310. Do this right. 310. Okay, there you go. Now look at the price. It's already breaking the 150 point level that the S&P is tracking since 2016. Look at these levels. Look at what happens here. Let me show you. Let me guide you. Okay, look at this. Comes here. There's 150 points here. Breaks, 150 points. Breaks, trades, 150 points. Breaks, new level, 150 point. Breaks, again, new 150 points. Now, this is where things get interesting, of a value for study. It comes into new 150 points, then it breaks down. Where it's going to trade? The new 150 point range. Breaks here. What is your entry? The risk of having another 150 points. So all this section, look at this, is based on 150 points. Prices.
When you say 150 points, it's $150.
Yeah, $150. Yes.
Okay,
no,
okay.
$150, 150 points.
Oh, okay.
Okay. So again, look at this. It's climbing up. I bet you can see here that it's a trend Fibonacci. Look at this. Trend Fibonacci. And this is 150 points. Here, doesn't sustain. Probably you get caught and start breaking to the downside. But you can argue that there is a double top in this during 2018. Breaks down. What it looks, 150 points. Again, breaks down, 150 points. And so, and so, and so. And again, it repeats the upside, 150 points, 150 points, 150 points, 150 points, 150 points. What else is going to happen? 150 points. Pretty simple.
Yes.
Now, having said that, what's the next stop for the S&P based on this weekly? Look at the time frame that we're working on. 150 points, 3,361. So I'm going to take this. Let me just 3,361. Okay, this is the unknown, but we know it's coming up here. Now, how is this going to take place? Simple. If there's a bearish rotation, what is our key support level? As we have seen from the last multiple weeks, we're talking 2016, 17, 18. 17, 18, 104, 6 months, 25, 127, 130, 2019. For the last 180 weeks to 190 weeks, there's 150 pip rotation. 150, $100, $150, 150 points. Now, if this takes place, I'm going to take the pencil. Pretty simple. What we're going to see is this. Okay, this level, 150 points, our base rotation,
points.
3060. It can go sideways, and if it breaks, look into a target. What is our next level? 2008, 2908. And then, wow, look at what we have here. I'm pretty sure we have a trend Fibonacci. And then, boom. Another 1, 2, 3, 3 levels of 150 points.
Yeah.
And will get us to that level.
Yes.
And then this rotation will represent 300 points to the downside.
Yes.
And what we'd say about the 5-year cycle, worst case on the presidential cycle, that we shouldn't be surprised of a minus 5% drop based on the presidential cycle. Do you see how everything comes to place and makes all the sense?
Yes.
That's simple. Let me show you one more, because we're in the last 10 minutes of this session. Another one. And this is the last one I want you to have in mind. And this information that I will send to you, the 3 charts, so you save them, print them, and slip them with them in front of you. Like, oh my God, this is happening. This is happening.
Yes.
This is a triangle formation. And there's always in technical analysis what fundamental analysts or quant traders always want to say about, because that's what they do. They fire to each other. They mock each other rather than understand how they can work together. One thing is not equal. For me to establish price rotation in stocks, I need to know what is the S&P 500. Yes. I also, as you mentioned, Jose, you told me, because I listened to you, Jose, can we trade, not fight the trend and trade these based on 50 when prices are above the 50? You see, you're analyzing, you're thinking it, because there's a lot on the line for us.
Yeah.
I'm reflecting. This can be the difference between you making $500,000 in 1 year and making nothing. You can see by now I'm positive that you know how powerful this is going to be in your trading. I'm pretty sure you know that. How much money you can make out of this. It's not luck what we're doing here. And with more money, you can do a lot more things for your family. You can do a lot more things for your friends, and it becomes easier. Remember, have you heard that they said like the first million is a difficult one?
Yes.
True. But after a million, making the second million, your 2 million, super easy. Why? Because you no longer will be needing Jose to make 100% or 200%. Because as soon as you make 50%, clack, $100,000. And then with that more money, as soon as you make 20%, $100,000. But the first million will be difficult. But rest assured, same conversation I had with Holly. When you learn this, it's just when. It's not if anymore. You will be rich. If you're not rich yet, you will be rich. Day by day, the opportunities for retail traders to make money are more than they used to be 20 years ago. Several reasons: technology, information. Information used to be protected by the big boys to make them look special to you, to make them look that they knew something that you don't know. That's no longer the case, Alan. There's nothing the other guy knows that you know that you don't have now. You have it. It's just practice, timing, and dedication. You put that together, nothing will stop you. Give you an example. Michelle faced some challenges at the beginning of the year because the insider report went to a little bit of a tough period because, of course, it's a loan-only portfolio. Okay. Now her mom died. I can't remember when, and she took her $800 account from her mom, and she already made close to $2,000. Small account trading.
Wow.
She has a job. She's a virtual assistant for a few guys. And she's trading. Her mom passed away and trading her little account. And I told her, you trade that little account the same way you keep trading, but in 2 years, you will take your mom Rest in peace. Small account to $20,000. Think about it. She already doubled her account.
Yes.
Doubling account, making extra big winners is no longer a case. It's no longer no longer a secret for us. This debate of the triangle, people all have speculations about the triangle, but this triangle, whatever you like it or not, you can choose to believe in the position, understand what happened or not, but it's there. The way I said this triangle is basically, again, portion of the rotation. The inside portion of the rotation of the triangle gives me the projection to the outside. And as you can see, look at this, push. At any given time, these candles never broke and open below the triangle base. This is the base. Okay. And what a lot of analysts, based on their bias, because they were biased, and I was never biased, mainly because I knew that the insiders were buying big time in this. This is the candle. You see, that's 2019, May 2019. That month, the insiders bought more than $150 million worth of stock. When the market went down this year, 6.71% on the S&P 500, insiders put into the market $150 million of skin in the game. Real skin in the game. So this was, again, you see, and that was the double bottom that pushed on the trend Fibonacci that you can see here. So this base, the base of the triangle, is the support. What happened now? Prices are trading outside the triangle. And if this is the range, the projection leads all the way to 3,600. That is not going to happen in 2020. It's not. This will take place sometime between 2021 to 2022. But this is the final range. Now, as you can see, once again, look at
once it breaks the triangle, then it would be on the downside now.
Yes, but the downside will have a limitation. 2 points to notice.
Right.
One, the end of the triangle that breaks, creates the support is 3,090. What we said about the presidential year, that we can have a 5% drop, and that will lead us to 3,080 to 3,020. And the triangle confirms that. Second, if we have a bigger drop, understanding, that will put us where? 2,879, which is not far from 2,861 that we already know based on trend Fibonacci. Everything's here, Alan. Let's see. Look at this here. Resistant, breaks. Now comes support.
Yes.
Number 5, in front of our faces. It's right there. Right there.
Yes, sir.
Absolutely. Look at that. Imagine, Alan. Imagine.
So beautiful.
And when people start talking their craziness on CNBC and sometimes on Bloomberg, you will be like, gosh, you never heard of the war room. Never heard of it. Oh my God, you dummy. What are you doing working for Credit Suisse and JP Morgan? Dummy. So these are the tools that you've been set in motion. Place and be ready, because this will happen in 2020. You get information. Sir. I will have a special video for all the war room members, paid members, in about 2-3 days. And this is going out because this all happened. I'm telling you, this is exactly how it's going to fold. And this is why in 2020, we're trading SPY calls and puts.
Yeah. Okay. So right now we're not expecting for the S&P 500 to go above 3289. Not anymore.
To go below right now, not to go below that for now. With the most we can see.
No, 3289.
Yeah, here. This will be the support.
No, I'm talking about the 3289. We're not expecting for it to go above 3289 for 2020.
32. Yeah, correct. Yes, this is our limit. This is our peak.
It's gonna draw down to the
Correct.
support.
Yes. Alan, I'm going to call you right away. We're closing the back-to-back sessions. I'm sure you enjoy them as I did. Call you back in a moment. And this is ICS number 20.